Good afternoon. Thank you all for joining us here today. I'm Anne-Marie French, Executive Director of the New Hampshire Fiscal Policy Institute, an independent, nonprofit, nonpartisan organization based in Concord. NHFPI focuses on the state budget, state revenue, the economy, and the economic security of Granite Staters. It is my pleasure to welcome you to today's event, Economic Impacts of the COVID-19 Crisis. Today's webinar features a two-part presentation examining the economic impacts of the COVID-19 crisis, both here in New Hampshire and in the surrounding New England region. Joining us for today's event are Jeffrey Thompson, Vice President and Economist at the Federal Reserve Bank of Boston and Director of the New England Public Policy Center, who will discuss the economic impacts of the crisis on New England. Jeff was the keynote speaker at NHFPI's 2019 annual conference, and we're delighted to have him back with us here today. Our second presenter today is NHFPI policy analyst Michael Polizzotti, who will present information about the impacts of the COVID-19 crisis here in the Granite State. Mike will provide insights regarding both the conditions in the state prior to the onset of the crisis and the effects of the crisis, including the consequences for the economic security of Granite State families and households. Following the presentations, NHFPI's senior policy analyst, Phil Sletton, will facilitate a question and answer session. At the start of this segment, Phil will also share a brief discussion of some of the key economic supports and stimulus included in the recently enacted American Rescue Plan. Today's presenters will be focusing on the impacts of the COVID-19 crisis on the region and our state, and the coming stimulus will be key to our ability to address some of the challenges that will be discussed here today, and to foster a strong economic recovery. We encourage you to use the Q&A function, which you will find at the bottom of your screen, to submit questions throughout the event. This webinar is being recorded, and we will post the link to the recording and the presentation slides to our website following the event. We'll also share the slides with you, the links with you, via email, so watch your inbox for those resources. And now it is my pleasure to introduce our first speaker, Jeffrey Thompson, for an overview of the economic impacts of the COVID-19 crisis in New England. Over to you, Jeff.
Thanks very much, Anne-Marie. I'm very happy to be here and be talking with your audience. So I'm attempting to share my slides and it looks like it's working. So as you suggested, I'll be focusing on the New England region, what's happened to the economy in the period since the COVID crisis first hit. And I should kick off by saying that sharing you the usual disclaimer, which is that the views expressed by me here today are those of my own and do not necessarily represent the views of the Federal Reserve Bank of Boston or the Federal Reserve System. So as we're all painfully aware, when COVID cases first started to spread in the country and in the region, it led to a very sharp, quick economic downturn. And this is something that we see across all sorts of data series, and I'll be sharing with you many of them today. And this type of communication with the public is one of the things that we do in the Federal Reserve System. Many of you are aware that the Federal Reserve is responsible for monetary policy and also bank regulation, but we also do a fair amount of research, macroeconomic research, but also regional research, and that's what the New England Public Policy Center does. We focus on economic and policy issues in the region. We do things like this sort of talk today, but also we do work focused on other issues that we think are important to the region, such as the opioid epidemic, affordable housing, education, finance, and more. But on to the regional economy. So when we look at one of the broadest measures that we have of economic activity, we can look to GDP. So real gross domestic product per capita fell very sharply. And so between Q1 2020, so that's January, February, March of 2020, and then Q2, April, May, June, GDP per capita fell incredibly sharply. And so here we see GDP per capita across the New England states as well as the US. And in fact, it fell sharpest in New Hampshire and Vermont, the declines of 11% for New Hampshire and 11.3% for Vermont. But they also, after the initial sharp decline, GDP recovered quite quickly. And what we see is that there's been was a sharp rebound between Q2 and Q3. Similar in magnitude in terms of percentage change, but still leaving us well below output levels from prior to the COVID crisis. Most of the slides I'll be sharing with you today are not focused on such broad metrics as GDP. Most of what I have to share with you today concerns the labor market, concerns employment, and concerns unemployment, some measures of prices and consumer expectations and business expectations. So without further ado, diving into the more fine-tuned metrics, which are mostly available at a finer frequency than quarterly, which does limit the ability for us to track how things have gone since the Q3 measure in GDP, which I'm showing you now. So this slide, in some sense, you can consider this slide, which shows trends prior to the previous recession, prior to the Great Recession, through the Great Recession, across the very long expansion from 2009 up till 2020, and then the sharp decline. In some ways, you can look at this slide as substituting for almost every slide you're going to see after, because there was something quite unique about the shutdown around COVID that stands out in a way that is quite interesting. You know, if you look back at the declines in employment around the Great Recession, you see that those job losses, which occurred in every New England state, which occurred in the United States total economy, employment fell 5% in many New England states. But those job losses unfolded over the course of 2 years. And you can see that on the left-hand side of the slide. When you look to the right-hand side of the slide, what stands out is that the extent of job loss was far greater, and in fact, 3-4 times as large in terms of percentage job losses. And they also were compressed into a 2 to 3 month period. So for New England, between February of 2020 and April of 2020, New England lost 18% of total non-agricultural employment. The rebound has been quite sharp, and I'll spend some time talking about the rebound, but it was compressed into an incredibly short period of time. And this was in part because this is not a typical business cycle. You know, the economic downturn didn't happen because of financial crisis, because of surging inflation, profit problems, whatever might have driven, you know, any business cycles in the past, but because we intentionally shut down the economy, both through our own individual actions to keep ourselves safe, but also through public safety actions to close down certain sectors, limit travel, etc. So a sharp decline in jobs followed by a very sharp rebound, leaving us nonetheless well below pre-pandemic levels. So we see that by January 2021, the latest state level data, New England is still 8% below pre-pandemic employment levels. The US average is 6% below. So those numbers very sharp and sort of awe-striking in a way, both in terms of the speed at which they occurred and their magnitudes. But let's put a little bit more, be a little bit more specific here. So what's the job loss that we're describing in that period? So February through April, the period of sharp job losses. Nationally, what happened was a decline of 22.4 million jobs. In New England, 12.5, pardon me, in New England, a loss of 1.4 million jobs. Similar magnitudes of job loss across the region. Some saw sharper losses than others, but not too far off of the decline of 18% of total jobs across the region. The period since April, so between April 2020 and January 2021, also a sharp rebound, but the recovery in jobs leaves us well below pre-pandemic levels. So we've replaced in New England 750,000 jobs over that period. So again, well short of the 1.4 million that were lost in the downturn. When we dig deeper into which sectors experienced job losses, we also are all well aware that there was considerable variation across sectors. So there's a lot of numbers. There are a lot of numbers in this table. So you can maybe return to it, download the presentation after and look and study them in greater detail. But they're ranked here in order of the level of job losses in the decline period in New England. So what we see is that in the leisure and hospitality sector in New England lost 422,000 jobs between February and April. Other sectors lost quite a few jobs as well. Education and health lost 225,000, but those are far fewer jobs compared to the size of the sector. So the job losses in education and health were only, and I say that's a struggle to say, only job losses of 14% being only 14%, but compared to the 58% decline in employment in leisure and hospitality, it was considerably smaller in the degree of losses. Similar patterns were seen across the rest of the country in terms of leisure and hospitality, seeing the biggest losses in percent terms, but losses experienced across every sector of the economy between February and April. The rebound in April to January, also quite sharp, but again, leaves us well below pre-pandemic levels. So between April and January, New England replaced 196,000 of those jobs in leisure and hospitality, but that sector is still 30% below pre-pandemic levels. One of the other interesting things about this sharp rebound period is that not every sector has recovered in the rebound period. So down here at some of the lower rows of data, we see that government and information are two sectors that have actually continued to lose jobs over this period. So government across New England lost 25,000 more jobs on top of the 70,000 that were lost in the early period. So government now 9% below pre-pandemic levels, and distressingly going in the wrong direction. So what more can we say about the sectors that have lost jobs? We can see what parts of the economy that they're in, but we can also, by looking at this slide, identify what types of wages were offered in those different sectors. And presumably, we're all aware that leisure and hospitality is a lower wage sector than, say, finance. We all sort of know that. But here are some numbers associated with it. So the left-hand side shows the degree of decline, cumulative decline between February 2020 and January 2021. So we see here leisure and hospitality, the largest net job loser, other services, and etc. But on the right-hand box, we see the wages, the average weekly wages in those sectors. So the two sectors losing the most jobs, leisure and hospitality, other services, are the lowest wage sectors of the economy. So the lowest paid workers saw the largest job losses, and that's consistent within New England. It's consistent across the rest of the country. Beyond being seeing large job losses and those job losses being concentrated among lower paid workers, unsurprisingly, these are also the sectors where we can identify experiencing the largest reductions in consumer spending. So this is a table showing declines in spending as tracked by the data service provider Affinity in their card spending, so credit cards and debit cards. We see data for all the states and New England and the US roll up. The top panel shows across all types of spending. The other panels middle panel shows what happened in grocery stores, and the bottom sector shows all food and accommodations. So all spending declined sharply between January and April in every state and the rest of in New England and all the rest of the states. But as the months wore on, the recovery started to take hold, and some states had, by summer, had started to see spending rebound. And in Maine and Vermont, already in July, overall spending had recovered to pre-pandemic levels. Grocery stores, though, have seen a huge boon in consumer spending, and they remain considerably elevated above pre-pandemic levels. US total spending in grocery stores is 21% above pre-pandemic levels, whereas food and accommodations, so think restaurants and hotels here, the decline was incredibly sharp and remains considerably depressed. So for example, in Connecticut, food and accommodation spending remains 25% below pre-pandemic levels. Another marker of travel in the hospitality, leisure, and travel sector, can look at traffic through Logan. And so we see the number of flights, both onboarding and departing flights, plummet just falling off a cliff compared to historic travel patterns, so number of flights, number of passengers. On the right-hand side, though, shows the volume of cargo and mail, which also declines, but rebounds pretty quickly. And although it certainly is below pre-pandemic levels, is not nearly as, was never nearly as depressed as passenger travel. So when we look at the other side of the job market, we've looked at jobs and some of the sectors where we've seen losses. What about the other side of the labor market from the job seekers perspective? We can look at unemployment, the unemployment experience. So a similar, this is in some senses is an inverted figure as the first employment figure that I shared with you. So unemployment spikes on the right-hand side, focusing on the COVID time. Unemployment spikes over just a couple of months and then recovers very sharply. And it's interesting, I think, to contrast this with the experience in the Great Recession. So unemployment rose sharply in that period, but the increase in unemployment actually unfolded more slowly. Well, over the period of about a year and a half, it rose steadily and steadily. Then it peaked and it remained flat for about a year, and then took the better part of a decade to return to pre-pandemic levels. Some states recovered more quickly, such as Massachusetts and New Hampshire. Other states like Rhode Island and Connecticut took much longer to recover. But the changes in unemployment in the COVID period, much sharper. So a huge spike followed by huge declines. And in fact, for Vermont, your neighbor to the west, has now in January 2021 an unemployment rate of 3.2%. So some states are back to be seeing pretty low rates of unemployment that some people would consider to be at full employment levels or close. There's a lot of variation around the region. And so on this slide, I zoom into the sub-state level and I look at unemployment rates at the metropolitan area level. And so we can see that comparing the most recent unemployment rates from January 2021 to January 2020, in most metro areas, unemployment remains somewhere between 2 and 3 times as high as it was pre-pandemic levels. You can see this on the top row for the Connecticut, Bridgeport, Stamford, Norwalk MSA. It's almost 2 points. It's almost twice as high, 7.9%, currently 4% previously. Lower down the slide, you can zoom in on the New Hampshire MSA levels, much lower rates of unemployment, but really lower at all times of the business cycle compared to other parts of New England. So Dover, Durham, most recent unemployment reading is 3.9%. Not quite as, certainly less than twice as high, but more than 50% higher than pre-pandemic levels. So below 4% in all 3 of those MSAs. So certainly can be expected to return to lower levels, but in some parts of the country and for the nation as a whole, 4% is considered pretty close to full employment. And when we zooming out to the regional level geographically, but giving some demographic detail, we can tell a similar story of unemployment and variation in unemployment. And so on the far left, we can see, so January, February unemployment in 2020 was around the 4% range. In the pandemic period, April, May 2020, it spikes to a little over 14%, and that declines sharply in the months since the April-May peak to being a little about 7% in January, February 2021. So sharp increase followed by a sharp decline, but remaining above pre-pandemic levels. And across many demographic groups, in fact, you see an identical pattern. You can look at males in the labor force, see a spike in unemployment and a decline. Females, spike in unemployment and a decline. The pattern is not identical, though, for every demographic group. So for example, if you look toward the middle of the slide and look at the unemployment rate among Black members of the labor force, you'll see a spike in unemployment and a slight decline from April-May peak, but really not much of a decline. For Hispanic workers, you see a very sharp spike, a much larger increase in unemployment among Hispanic workers than really any other worker type and by race or ethnicity, and also a sharp decline, but remaining very high, elevated, more than twice as high as pre-pandemic levels. You can look at by educational attainment. There's some interesting patterns. The biggest takeaway is that if you have a college education or more, your unemployment did spike fairly dramatically for that group of the workforce, but has declined to being fairly close to pre-pandemic levels. So there's a number of takeaways, a number of ways to look at this slide. Certainly there's inequality across demographic groups in the labor force, but if you shift the perspective to say, well, how do we think about the current labor force? Is the current labor force activities and labor force dynamics, have we gone back in some sense more or less to pre-pandemic levels, or are we remain in a very different state? And there certainly are measures that you can look to sort of suggest that in some respects the labor market has returned to dynamics from the pre-pandemic labor force dynamics. One of them would be the openings rate. So this is, I'm showing here a trend in openings rates. This is number of openings offered by firms in the numerator and divided by the number of jobs available in the previous period. So the rate of openings available in the labor market as we crashed into the COVID downturn fell sharply, unsurprisingly. But openings relative to previous period jobs has really recovered to pre-pandemic levels nationally, which is the blue line, and even within New England, which is the gray line. Another metric of labor market activity that is essentially points to return to business as usual is this measure from the BEA on compensation of private industry workers. So we show compensation in the solid line and followed by wages and salaries. And so this is median wages and salaries and median total compensation of employed workers in private industry for New England, and then in gray, and then for the rest of the country in blue. So you see greater wage and compensation growth in New England relative to the rest of the country. But importantly here, you see continued growth. In fact, the rate of growth in compensation has continued unabated. And if anything, nationally, the growth in compensation and wages and salaries has even picked up a little bit in the downturn period. But this is really just a composition measure, right? This is essentially circling back to the fact that the folks who lost their jobs were among the lower paid workers, as that if the people who have continued to hang on to their jobs have in fact continued to see relatively solid growth in wages and salaries. So that's what we're seeing. So what we have here is among those who retain their employment, much about what's going on in the workforce and the labor markets looks how it did before, but there's huge numbers of workers who remain unemployed. And one way to dramatize this and to really draw this out is to focus in on not the unemployment rate, but different measures that bring in the full range of population, and also focus on labor force participation decisions. And that's what I've done here for a few slides that I'll skip through. By demographic group. So this slide shows for males and females and also identifying workers who have no kids versus those who have kids. It's looking at their employment to population ratio in the pandemic period indexed to pre-pandemic levels. So all of the lines start at 1 in February of 2020. So when the pandemic hits, there's a huge drop. A lot of people lose their jobs. But starting in April, the rebound kicks in. So people are going back to work. But really, the employment to population ratio never really gets above 95%. And around September, end of summer, it sort of peaks, and it's been flat, and if anything, declining since then. So the total jobs remain 5% below pre-pandemic levels for males, for females, workers with kids, workers without kids. And that's partly workers remain unemployed, but also partly workers are dropping out of the labor force, because you can only be unemployed if you either, to be unemployed, you have to be in the labor market. So you have to be without a job and looking. So people have dropped out. And you see this based on this set of demographics, and also you can see it when you look across different demographic groupings. So here I'm showing you by race ethnicity categories. So huge declines in employment to population ratio in New England among particularly sharp, well, they appear among all worker types, even among white workers, the decline was 15%, but they're particularly sharp declines in EPOP for Hispanic and Asian workers. But after April, there's a rebound. But really the only group to recover their employment to population levels compared to pre-pandemic levels is Asian workers. White workers remain 5% below. The numbers for New England is a heavily white region racially, so the numbers jump around a little bit for all the other racial groupings. The numbers in the survey are not large enough to give you smooth and steady numbers, but if anything, they're suggesting, well, certainly they haven't recovered to pre-pandemic levels, but if anything, they seem to be heading in the wrong direction. The most recent month of data suggests that the employment to population remains 15% below pre-pandemic levels for Black and for Hispanic workers. And by education, the story is not all that different, really. What we see here is in the orange line is that college workers saw the mildest decline in their employment to population ratio, so they only saw job losses of 10%. But since that time, and increasingly since the fall of 2020, they've come pretty darn close to returning to pre-pandemic levels. They remain a shade below, whereas the other educational groupings, somewhat more volatile, but pretty steadily below pre-pandemic levels and not increasing, probably declining since the fall. So one clear takeaway is that while the recovery shot out of the gates with a bang in the early months, April, May, June, really since September of 2020, the rate of recovery has slowed. So this slide just sums all that up, identifying the share of total jobs that were lost in the downturn that have been replaced since April. And it really has been flattened out since September, and we've only replaced just a little over half of the jobs, and we appear to be in a holding pattern in terms of replacing employment. And that's somewhat dramatized here by the UI claims. So if anything, in recent months, a handful of New England states have seen fairly dramatic increases in initial claims. Back in October, November of 2020, Massachusetts saw a huge spike. In more recent months, Rhode Island saw a huge spike in initial claims. So it's not just that we have flattened out. We are adding jobs, certainly, but we're also continue to lose jobs. And I will put a little bit of a cautionary note on any of the series that rely on unemployment data, UI claims data, and that the level of fraud that the system has detected has been pretty large. So most of the fraudulent attempts to claim unemployment insurance have been detected and denied by the system. So the system is by and large working, but it's still disturbingly large numbers of fraudulent claims are being approved and ultimately being paid. And I have a little bit of detail on the note. So some of the dramatic spikes in UI claims are probably overstating the extent of job loss at any given point in time, but they're certainly pointing us in the right direction. So I've got a few more minutes, and I want to point to a few data series on consumer prices, housing, and attitudes and consumer and business sentiment. So all of these measures of economic activity in terms of employment and unemployment would lead to pretty depressed conditions for consumer prices, and that's unsurprisingly true. So we see that in the Boston Metro CPI, as well as the US CPI, consumer prices have grown at very low rates. Consumer prices were flirting with actually going into deflationary territory early in the pandemic, but have rebounded somewhat since that time nationwide, but remain very, very low rates of price growth in New England. And of course, prices are not changing equally across all sectors. And this slide shows a change in CPI over the last year by by sector. And what we see is that, in fact, prices for food have risen at a steady clip, and that's unsurprising. A lot of this would be picked up in grocery, although restaurants are included here as well. So where are people spending their money? They're spending in grocery, and that's where we see prices rising. Recreation, transportation, though, very sharp price declines. One sector that's where we see fairly moderate price increases is in the shelter sector. And some people are a little bit surprised when they hear that. But for consumer prices, shelter picks up rents paid, which if anything have seen downward pressure in certain markets. But they also, for homeowners, they only pick up a portion. They pick up essentially the homeowner's use equivalent. It's not the price tag on the home for home buyers. When you do shift your purview to look at home buying, though, that is where you see some evidence of very sharp increases. So this is quarterly data showing for New England and the US. If anything, in the downturn, we've seen the opposite experience of what we experienced in the previous pandemic, previous recession. The previous recession was very much associated with crisis in the housing sector and in the financial sector. Here, not at all the case, and we see sharp spikes in home prices. So this is unsurprising as people have flooded to buy second homes, and the market has remained, the supply of homes has remained somewhat restricted. On net, though, I actually remain more optimistic about the housing sector because a lot of this activity, this home buying activity, which we see indicated on the left-hand side of this slide, which is benchmarked to pre-Great Recession levels of home sales. We've seen an uptick in home sales, unsurprisingly, but the middle on the right-hand slide actually show the number of housing permits and housing starts. And all this housing activity on the buying side has, in fact, seemed to have spurred more housing permits to be undertaken and more starts to be commenced. So the housing market is sort of, I think, on net should be considered to be looking into the positive territory moving forward. Consumers, when the pandemic hit and the economy shut down, the consumer outlook declined dramatically, but has since arrested its fall. So if anything, it's flatlined. And most of that, though, the decline in consumer sentiment is the consumers' assessment of their current situation. When you ask consumers about their future set of expectations, if anything, in New England, consumers in February 2021 are looking a little bit more optimistic than they were a year ago. The opposite is true for the rest of the country. So consumer sentiment fell off of a cliff, but is flatlined, and the future orientation modestly positive compared to last year. Businesses, though, their sentiment and their business confidence has rebounded really quite sharply. So here I have 3 slides. On the left-hand side, I'm showing you the Associated Industry of Massachusetts, their business confidence index. Unsurprisingly plummeted in the pandemic period, but has since returned to expansionary territory. The Cass Freight Index, which essentially adds up total freight shipments by truck, by rail, by any mode of transportation, freight is shipped within the continental United States. It fell sharply, but it's rebounded and essentially is at pre-pandemic levels. And the Purchasing Managers Index, Institute for Supply Management, their metric, which shows expansion in the manufacturing sector, is back into positive territory. And if anything, is as high as or slightly higher than pre-pandemic levels. Even before, it's higher than it's back to pre-trade war levels, in fact. So manufacturing, very optimistic looking forward. So I'm out of time, so I'm going to just give a few parting comments in terms of wrapping up and concluding. So obviously, very sharp job losses, economic trauma that affected the region as the economy shut down so people could stop the spread of the virus. And people were also put out of work through sectors shutting down. The future, we are on recovery, but the recovery seems to have flattened out. And the future path remains somewhat uncertain, but the future path of recovery will of course be driven by how well we continue to respond to the virus, and also the consequences and the effectiveness of economic policy actions. So a couple final pictures, and then I'll conclude. This one is showing 3 lines that tell the story of the massive influxes of fiscal stimulus into the economy in the COVID period. So on the right-hand side, you see these 3 lines. You see in the red, consumer spending, so personal consumption. As the COVID pandemic takes hold, consumer spending falls off a cliff, incredibly sharp declines in consumer spending. But the dark blue line at the top spikes immediately thereafter because the CARES Act kicks in and pumps $2 trillion into the economy over fairly short order. So consumption rebounds dramatically, but remains fairly depressed below pre-pandemic levels. But what also happens during that period, so consumption doesn't return to pre-pandemic levels, but the savings rate, which is the blue dashed line along the bottom, spikes and remains incredibly elevated. And then the most recent spike in data for income and even consumption is associated with the previous relief package, which was implemented in December. We also saw a huge spike in personal income, and also an uptick in consumption, and importantly, an uptick in the savings rate. So what we have here is we have consumers holding on, but there's a lot of the economy that's dependent on consumption. But the consumers are not spending as much as they used to, so savings have increased. So a lot of economists have talked about this dynamic and envision sort of like potential flood of demand that's been suppressed because of public health precautionary measures that could be released. And what's going to release them? Well, they're going to be released when people feel free and safe in traveling, when they feel less fearful of catching the virus. And in fact, we have seen dramatic declines in the spread of the virus. So this is cases per 100,000. And I've chosen two states from New England, which sort of highlight the Connecticut and Massachusetts were sort of poster children in the first wave expansion, all the way on the left-hand side. Once we recovered from those early spreader periods, other states were the epicenters, the new epicenters. From the summer, Florida was the epicenter. Later in the fall, we saw spikes in Wisconsin and the Midwest, and then the rest of the country sort of exploded in terms of case spreading in the winter. And then we've all been coming down together. So public health actions, masking, but also importantly, the availability and the spread of the vaccine. So the vaccine has been, doses are getting in people's arms, shots are getting people's arms. And so the top line, the gray line, is showing the share of the New England population, which has at least one vaccine dose, and it's been rising sharply. So now we're above 1/4, and we're heading rapidly toward 1/3. These numbers will continue to rise. And as more people are vaccinated, more people feel safe, we can fully expect consumers to feel more comfortable traveling, going out to restaurants, and that backlog of demand will push forward and will help rejuvenate those sectors that continue to see subdued employment. So I'm going to end there, and thank you for allowing me to go over by a few minutes, and I will stop sharing my slides and hand it back to Anne-Marie.
Great. Well, thank you, Jeff, for providing that overview of the impacts here in the New England region. And now let's turn our focus to New Hampshire, and I'm delighted to introduce our second presenter, NHFPI policy analyst Michael Palazzati, to review the impacts of the crisis here in the Granite State. Michael, over to you.
Great, thank you, Anne-Marie. I am just going to start sharing my screen, and it looks like everyone can see it. So again, thank you, Anne-Marie, for your introduction, and thanks to Jeff for your presentation as well. So my name is Michael Palazzati, and I'll be presenting during the second half of the webinar, where the focus will be centered on the impacts of the COVID-19 crisis in New Hampshire and on Granite Staters. So before we begin, I'd like to provide a brief overview of what this presentation will cover. So before discussing the impacts of the pandemic, it's important to understand how the recovery from the Great Recession over the last decade progressed. So we're going to do this in order to understand how well equipped Granite Staters were to weather this current crisis. So after we establish this background, we'll then focus on the economic and employment effects of the COVID-19 crisis over the past year, and that'll be at the state, county, and industry level. And then lastly, we'll cover some of the impacts and challenges that have resulted from the COVID-19 crisis, focusing on households in New Hampshire. So in this first section, we'll discuss some of the trends in the recovery from the last recession, the Great Recession, and the challenges that existed before the current pandemic began. So it's important to remember that the Great Recession resulted in some significant employment declines and shifts in employment overall. So industries that had lower than average wages saw some of the most overall saw some of the highest levels of overall employment growth when comparing employment during the Great Recession to 2019 in New Hampshire. So this chart here shows the green bars representing the industry employment growth in that industry, and the blue bar representing what the average wage was in that industry, with the blue line representing the average weekly wage in New Hampshire in 2019. So we can see here the overall employment changes from 2008 to 2019. The industries that saw the most employment growth, like healthcare and social assistance, administrative and waste services, accommodation and food services, and others, were a majority industries that had lower than average wages in New Hampshire. Now, on the contrary, some of the industries that paid higher than average wages, like manufacturing, have experienced some of the largest overall declines during the recovery from the Great Recession in New Hampshire when comparing 2008 levels of employment to 2019 levels. Now, along with the overall shifts in employment from 2008 to 2019, the real wages of workers in New Hampshire also changed fairly unevenly as well. And these real wages mean that the wages are inflation adjusted. So some earners saw overall wage growth and others experienced real wage stagnation or declines in the state. So this chart here shows that higher wages or wages that were higher than the median in New Hampshire, which is represented by the blue bars, experienced large overall levels of real wage growth during the recovery from the Great Recession, while wages equivalent to the median or below experienced no clear real wage growth overall. And it's also important to note that these wages that were lower than the median actually declined during much of the recovery. And they only recently returned to pre-Great Recession levels when adjusted for inflation in more recent years, encompassing 2017 to 2019. So in addition to the employment and real wage trends over the recovery from the Great Recession, other inequities persisted as well. So using the most recent estimates from the American Community Survey, which encompasses averages from 2015 to 2019, we can identify several points in this chart. So this chart shows that prior to the pandemic, median household incomes and per capita incomes were lower for households and individuals, identifying as Hispanic or Latino, Black or African American, or two or more races in New Hampshire. And this same data also shows differences in poverty levels as well, based off several factors. So those same individuals identifying as Hispanic or Latino, Black or African American, two or more races, along with children, those with lower levels of education, and part-time workers all had higher poverty levels in New Hampshire before the pandemic. And now these trends that I just mentioned are also true of families as well. So families with children, families that had lower levels of education, the householder who had lower levels in education, and families who rent their homes faced higher levels of poverty. Also, these data show that families headed by single women had substantially higher poverty rates, regardless of other factors. So the green bars on this chart represent the estimates for all households in New Hampshire in that category, and the blue bar shows the disparity for households that are headed by single women in New Hampshire. So for example, when looking at families with related children under 5 years old, you can see that the blue bar, the rate for the estimated rate for households in New Hampshire that are headed by single women is much higher than the estimated rate for all families. And looking at household income before the pandemic now, estimates from 2019 show that about 1 in 5 households in the state had incomes of less than $35,000, which is shown by that dark orange slice. And about 1 in 3 households in the state had incomes below $50,000, which is shown by both of those orange slices together. And these same pre-pandemic data present some other insights into the expenses for renters in the state as well. So typically the Department of U.S. Housing and Urban Development notes that families paying more than 30% of their incomes on housing are considered cost burdened, and they may have difficulty paying other expenses. So before the pandemic, just under half of all renters in New Hampshire were paying more than 30% of their income on housing expenses. And that's shown here on this chart by the orange slice in this pie. So transitioning to the COVID-19 crisis, we've seen some profound challenges to the health and economic well-being of Granite Staters over the last year. And the employment impacts have been severe, like Jeff mentioned. And there have been some disproportionate impacts to lower income Granite Staters as well. So when we look at estimated levels of unemployment, we can see a large spike as a result of the efforts to control the pandemic. So these elevated levels of unemployment surpassed what resulted from the Great Recession, as shown on this chart. So we can see that with the blue line, which represents New Hampshire's monthly unemployment estimates back to 2007, and the green line, which represents the nation, that these estimates have declined significantly from their peak levels, which were experienced in mid-2020, but they're still elevated. And, sorry about that. And one important thing to note as well when looking at these unemployment estimates is that this official estimate of unemployment, an important thing to note is how it's measured. So this measure takes the number of unemployed people and divides it by the labor force. And because of this, it fails to capture underemployment, folks who may be working part-time when they want to be working full-time. And it also fails to capture discouraged workers as well, so individuals who may have stopped searching for work. And we'll discuss these points a little bit more later on as well. So to respond to those elevated unemployment or those elevated employment losses throughout the pandemic, unemployment insurance claims also reached unprecedented levels in New Hampshire. So the green line here shows the weekly initial unemployment claims, and the blue line represents continued claims, which are when an individual is recertifying for a new week that they're still out of work. And both initial claims and continued claims for unemployment benefits continue to be elevated above pre-pandemic levels. And in mid-2020, they also reached levels that were much higher than reached as a result of the Great Recession as well. So it's the unemployment chart that I showed earlier did show that significant drop when compared to estimates, the estimated levels in mid-2020, so coming down off that large spike. But we know that nationally, unemployment levels for different groups of workers aren't the same. So non-white and Hispanic workers, those with lower levels of education, those are groups that continue to face higher levels of unemployment. And that may be true in New Hampshire as well. And also nationally, the percentage of workers employed part-time involuntarily due to weak business conditions or lax economic conditions are still elevated compared to pre-pandemic levels as well. Also nationally, the percentage of unemployed people who are experiencing what's called long-term unemployment, which means they've been out of work for at least 6 months, is hovering at around 40% of those individuals who are unemployed. So these factors together may indicate that the large decline in unemployment that we've seen in the official unemployment estimates may not be equally felt by all groups. Now, the number of people in the labor force in New Hampshire has also declined, as did the number of people employed. So labor force levels in the state on this chart comprise of the number of people who are working or who are unemployed and actively looking for work. So both the labor force, as shown by the blue line in this chart, and employment, which is the green line, are still below pre-pandemic levels. And that means that about 10,000 less people are in New Hampshire's labor force and about 17,000 less people are employed in New Hampshire when we compare January 2021 to January 2020. And it's important to remember that that's after the recovery we've had so far. So there's still a significant amount less people in the labor force and employed in the state. So participation in the labor force has also experienced significant declines as a result. In New Hampshire, current estimates show that about 67% of individuals over the age of 16 are employed or they're actively looking for work. And this is about 2 percentage points below pre-pandemic levels as shown on this chart. Now, workers leaving the labor force at the highest rates tend to be women, particularly women with school-age children. And these changes in the labor force may also be attributing to lower unemployment estimates as well. And that's because when people leave the labor force, they aren't factored in as being unemployed or employable to the estimate. So they haven't been actively seeking a job, and that may be contributing to these lower levels of unemployment we've been seeing. So given those indicators, there's also been an overall drop in the employment population ratio, like Jeff mentioned. This metric measures the percentage of the population that has a job. And currently it sits at about 65%, which is about 2 percentage points lower than pre-pandemic levels of 67% in New Hampshire. So with all of this information, we know that the interactions between unemployment and the labor force declines we've seen may signify that more people are out of work than estimated. And it's important to remember that the official rate, or the official estimated rate of unemployment only counts individuals who are in the labor force, who are actively or very recently actively looking for work, but have not found employment. So this official estimate of unemployment doesn't capture those individuals who are working part-time when they want to be working full-time. It doesn't capture those individuals who have lost their job and stopped searching for work, especially those discouraged workers, so those folks, like I mentioned, who have stopped looking for work as a result of the pandemic. And it's also important to remember that certain groups are facing higher levels of unemployment than others, which may be indicative of these official top-line estimates not completely telling the whole story. So now transitioning to some of the county and industry level employment impacts, we see that, we've seen that different geographies in New Hampshire experience different employment impacts. So certain service-based industries were most affected by employment losses, and industries paying lower than average wages experienced some of the largest employment declines in New Hampshire. So when looking at county unemployment estimates, some of the largest impacts were in more rural regions of the state. So as shown here on this chart, places like Belknap County, Carroll County, and Coos County, all more rural regions of the state that experienced higher peak levels of unemployment in April 2020. So this may be attributed to the composition of jobs in these regions or counties. So these places may rely more on industries that rely on physical interactions, tourism, and other service-based industries that weren't able to adapt as quickly or adapt at all to a model that limits in-person or physical interactions between people. And also looking at the breakdown of unemployment insurance claims over the last year helps to show us the massive employment losses, but it also shows us which industries have been most impacted. So by looking at the distribution of unemployment claims by industry, this chart here shows that since the pandemic began, so starting with measurements in March 15th of 2020, that since the pandemic began, a significant portion of initial unemployment claims have been generated by those industries that paid lower than average wages in New Hampshire. So here the blue bars on this chart represent the total number of initial claims in that industry. The green bars represent what the average wage was in that industry in 2019, and the green line represents the average weekly wage in New Hampshire across all industries. So we can see that industries like food services and drinking places, administrative and support services, educational services, social assistance, these were all industries that saw some of the highest levels of unemployment insurance claims, and these were industries that paid lower than average wages in the state as well. So this indicates that large portions of the job losses and the losses in employment income for these individuals have been most acutely felt by lower wage workers in these lower wage industries. So other analysis shows similar findings as well. So that the largest industries or the largest employment losses were among these lower wage industries. So this analysis here is from researchers at Harvard and Brown universities, and it shows that low and middle wage employment in New Hampshire saw some of the largest declines as a result of the pandemic. So these jobs in lower and middle wage work, which are represented by the blue lines and the teal line, haven't recovered to pre-pandemic levels in New Hampshire, as shown in this chart. Notably though, higher wage employment, which is shown by the red line in this chart, has recovered fairly quickly and is back to pre-pandemic levels in New Hampshire. And all of these numbers are indexed to January 2020. So comparing to January 2020, higher wage work actually may have seen a little bit of growth. Middle wage work, which encompasses wages from $27,000 to $60,000 is down by about 7%, or estimated to be down by about 7%. And lower wage work, which encompasses wages, yearly wages below $27,000, is still estimated to be down about 32%, according to this analysis from these researchers at Harvard and Brown. So now we can look at some of the results of these employment impacts on Granite Staters in New Hampshire. So to quantify some of these impacts, we can turn to estimates that are provided by the Household Pulse Survey. So this survey is conducted by the Census Bureau, and it's either weekly or bi-weekly, depending on what period you're looking at. And the main goal of this survey was to improve understanding about what the household level impacts of the pandemic were in each state. So in New Hampshire, nearly half of adults reported an employment loss or a loss of household employment income between March and January 2020, earlier on in the pandemic. And at the end of 2020, about 1 in 4 households expected future employment income losses. And about 1 in 3 reported difficulty paying for their usual household expenses too. And also from about April 2020 to March 2021, between 4 and 12% of households in New Hampshire indicated that there was sometimes or often not enough to eat in the last 7 days. So focusing on that last point, the estimated levels of accessing food or accessing enough food, which the Census Bureau calls food scarcity. We can see that it's tracked this way since the initial data collection period in April 2020. And this may mean that the challenges in accessing food may have been sustained throughout the pandemic since the data was originally collected in April 2020. Now, in terms of estimates for difficulty covering expenses or covering household expenses generally in New Hampshire, which includes things like housing, food, insurance, anything that's considered a usual expense by the people who are answering these questions. This graph here shows that about 1 in 4 households reported that it was somewhat or very difficult to cover their usual expenses quite recently. This data here is from the second half of February 2021, so only a few weeks ago. And when tracking these estimated levels of households indicating difficulty covering expenses, when we track it over time, this chart shows that since August 2020, between 1 in 4 and 1 in 3 households in the state have found it somewhat or very difficult to cover their usual household expenses in the last 7 days. And in addition to those estimates from the Household Pulse Survey, the costs of key expenses have risen as a result of the pandemic. So as Jeff mentioned, there have been cost increases overall to the cost of food, notably food that's bought to be prepared at home, like from grocery stores and places like that. And there have also been notable increases in the cost of housing, general household expenses, and certain personal care services as well, resulting from the pandemic. And given all these challenges facing Granite Staters, the levels of overall need for economic assistance in New Hampshire have been rising over the past year. So the green line here on this chart shows that unduplicated open cases for economic assistance, which includes programs like SNAP, New Hampshire Food Stamp Program, TANF, Temporary Assistance for Needy Families, Medicaid. They've increased overall, and they've been steadily rising since the pandemic began, especially when we compare the blue line here, which represents what the cases were for a period in late January. So they're fairly elevated, and they have been rising fairly consistently. Now, there have been significant policy responses in the past year that have substantially helped the economy begin to recover. And these policies included things such as the expanded and extended unemployment benefits, the economic impact payments, changes to certain public aid programs, rental assistance, moratorium on evictions, and aid to state and local governments. And just to reiterate, these policies have been integral to promoting the recovery so far, and they'll be important to continuing the recovery in the future as well. So in summary, there are several key points from this presentation to remember. The uneven recovery from the Great Recession left many Granite Staters less prepared to weather this current crisis. The current COVID-19 crisis has resulted in some of the most acute employment losses among workers earning lower wages and in certain service-based industries. And it's also important to remember that many of the top line indicators have improved greatly from their most severe levels, which were typically experienced in mid-2020. But they may not be indicative of the recovery reaching everyone. And notably, there are many individuals who are leaving the labor force or who are facing underemployment or long-term unemployment or discouraged workers. Additionally, there may be some lingering impacts as a result to regions, industries, and people of these employment shifts and employment effects. We know that there have been disproportionate impacts on certain groups, such as women and certain racial and ethnic minority groups. But we do know that the policy actions that have been implemented so far have contributed significantly to the recovery so far. And it's important to remember that continued investments to support those individuals and families and places that are most impacted can be extremely vital in fostering a more equitable, inclusive, and sustainable recovery that continues into the future. And with all that, thank you for your time and attention, and I'll invite Anne-Marie to come back on.
Great. Thank you, Mike, for that very informative presentation highlighting the impacts of the crisis on the Granite State. As you noted, the crisis has disproportionately impacted certain populations in the state, and the uneven recovery from the Great Recession had not reached many Granite Staters, further compounding the problem. And now I'd like to turn this over to NHFPI's Senior Policy Analyst, Phil Sletton, to provide us with some highlights of the latest round of federal stimulus that will be coming in to support New Hampshire's recovery. And Phil will also be facilitating the question and answer segment. So Phil, over to you.
Thank you very much, Anne-Marie, and thank you everyone again for your time this afternoon. So I just want to touch briefly on some of the key provisions of the American Rescue Plan Act. The American Rescue Plan Act is designed to support the U.S. economy broadly during the remainder of and the recovery from the pandemic, specifically by focusing resources on people with low incomes and people who have lost work. These efforts, as well as support to key organizations that are providing services, both provides support to during the remainder of this public health crisis, and was designed to function as stimulus when the economy is safely to shift into higher gear. So this could have a pretty significant impact based on that design. In particular, extending food assistance benefits through enhanced supplemental nutrition assistance program benefits, known as the food stamp program in New Hampshire, and providing more support through unemployment compensation are two of the most effective ways to stimulate the economy. That's one of the things that we've seen from research around past recessions, around the Great Recession and the recovery from the Great Recession. So these policies are very effective because they get resources into the hands of people who need them and will likely use them quickly in their local economies. So it's a very effective way to stimulate economic growth. Similarly, the expanded earned income tax credit, and in particular, the expanded and fully refundable and restructured child tax credit, likely will provide a significant economic boost through the same basic mechanism, resources going to people who have a limited amount of resources to begin with, particularly after the recovery from the pandemic or after the pandemic. And the potential for regular monthly payments of the child tax credit amount could also provide a more rapid boost to the economy than the child tax credit coming in a more latent fashion. The $1,400 per person economic impact payments could also have a significant stimulative effect, as could the enhanced subsidies for health coverage, which would free up other household resources that would have otherwise gone to insurance premiums. So the American Rescue Plan Act also provides significant aid to state and local governments. And aid to state governments has been effective economic stimulus, both during the Great Recession, the modeling suggested was effective economic stimulus then, and during the COVID-19 crisis from the last economic packages that we saw back last year. It was estimated to be among the most stimulative forms of assistance, and particularly in this during the COVID-19 crisis. So the one federally generated revenue estimate that I've seen, and all these estimates are subject to change based on the details on policy implementation of the American Rescue Plan Act once those become available, and once we know more about the policies that are promulgated at the federal level, we'll have a little bit more clarity. But one estimate that I've seen suggests that New Hampshire would receive about $950 million, and local governments, including counties and municipalities, would receive another approximately $450 million in grants. And school districts would receive separately $350 million, including funds addressed at learning loss during the pandemic. And I'll highlight two more areas. One which faced critical stresses before the pandemic in New Hampshire that are key parts of this really vast economic support package that covers a significant number of areas. So this is not a comprehensive review. More money will flow to New Hampshire with one estimate of about $80 million to support childcare for low-income individuals and help childcare providers. This helps enable workers to return to the economy when the childcare infrastructure in the state is robust and allows people to then access childcare and engage in the economy through work. There will also be assistance for housing that's funneled through emergency housing vouchers for situations where individuals or households are at particular risk, and as well as assistance to homeowners. So the American Rescue Plan Act is both targeted and timed in such a way that it could provide a really significant economic stimulus in the short and medium terms. And with that, I'd like to turn to questions. So I'll invite Jeff and Michael back into the group. And I have a couple questions for both of you. I'll start with a technical question. This one goes to you, Jeff, first. You showed the changes in employment that included the categories of government and education. And one clarifying question was around whether local school employees would be included in the government category or the education category.
Can you hear me? Oh, I'm
Yes,
unmuted.
yes, we can hear you.
That's a great question. And off the top of my head, I'm actually drawing a blank. So I'll have to look into that. So I cannot answer your pointed question.
Yeah, no, I've seen and I've seen in economic data broken out in different ways depending on the source too. So it's not always clear. One other technical question, and I'll stick with you, Jeff, on this one. How is the unemployment rate interpreted in the context of in the context of this economic recovery? Do we expect the labor force participation rate or the employment to population ratio to be more useful metrics as we watch this particular recovery unfold relative to what we've seen in the past?
I think certainly the broader measures that take into account labor force participation changes would be the most important metrics to look at in terms of judging the health of the recovery. There's just no reason to believe that, over the course of a handful of months that you would see any justifiable long-run shift in fundamental attachment to the labor force of the magnitude we've seen. So these people, these very large, 5% decline in employment to population, these are people who should be expected over the course of a healthy recovery to return. So I think they should be viewed as potentially part of the labor market. Now I should say that, some of those folks might be difficult to tracked back because if our benchmark was the end point of a very long economic expansion, and in New England particularly, we did see increases in labor force participation that have been very hard to achieve. So I would say that the bulk of the people who have stepped out of the labor market can be expected to return, but it will be hard to get them all back in.
And Mike, I actually want to take off that point and go to a question for you as well. So given the higher percentage of older residents in New Hampshire relative to other states, can the labor force declines be partially explained by sort of an early retirement or people leaving the labor force and potentially staying out for a longer period?
So it could be attributed to that. We also know that in New Hampshire and nationally, higher portions of younger people are facing unemployment as well. So while the argument of people taking their retirement early could be a factor, there's also a significant portion of younger people who are facing unemployment and who may have stepped out of the labor force for the time being as discouraged workers or workers who are facing long-term unemployment as a result.
Okay, great. And this is another question while we're talking about analysis of employment and unemployment. Does the, and I'll go to Jeff first on this one, does the federal waiver of so some of the requirements around the need to look for work while people are enrolled in unemployment compensation assistance, some of those requirements that are typically in place have been waived at various points over the course of this pandemic. So I'm curious, and this questioner is curious, do those waivers affect the overall employment and unemployment analysis when we're thinking about these, some of these numbers that you've shown us here?
I mean, that's a really good question. In a technical sense, they don't, because the metrics of the unemployment rate, for example, is a household survey, and they don't ask in that survey if you're on unemployment insurance. They don't ask in that survey they do ask if you're looking for work, but that information is not transmitted back to the state departments of labor. So informationally they're distinct. So, but conceptually, they're probably related in that, and I think oftentimes when people probe this question, the concern is, not wanting to have unemployment assistance, support people, prolong states of unemployment when they should be return to work. So at some point, that sort of decision point and how pressing that is for policymakers will become active. It's hard to say. I would be hard pressed to say that we're there yet. This economy, the job loss that we saw was essentially we froze the economy for public health reasons, and it led to a massive shock to households. So the unemployment assistance really has been vital in supporting the economy more broadly. And at some point, we will return to more sustainable, normal rates of growth. And so we're probably in that taper period. But, the numbers that we've been posted on the job creation side have been fairly unimpressive. So the point at which I think from a policy perspective, you start to worry about is the presence of these unemployment insurance benefits inspiring people to not go back to work. I don't think that's the first order concern at this point in time. Down the road, that could change.
Okay, Mike, did you have anything you want to chime in with as well?
Just building off of that a little bit. So Jeff, you mentioned the employment recovery in a sense. So the chart or the analysis from the Brown and Harvard University researchers, we have seen that this lower wage work and this middle wage work, which encompasses significant portions of employment in New Hampshire, is still down significantly as a result. So that plays into this as well.
Right, and I will ask as well about, and I'm going to go to Jeff first on this one. Is there any way to tell how much of the success in New Hampshire business or in business more speaking more generally can be connected to either government contracts, whether that's around COVID-19 related expenditures, or the result of both government demand for those services that are specific to the pandemic, or government assistance, right? Government assistance through whether it's the payroll protection program or other grants and loans.
Unfortunately, I'm going to have to say that I don't think we're yet in a position. I mean, these are the questions that, of course, you want to know in the thick of it and as it's happening, but you really only get a fine, detailed answer as it's in hindsight. So, what we can see is that in terms of the fiscal stimulus and all the different, you talked about some of the different ways in which the most current package, the 1.9 trillion ARP, but we've had two previous very massive rounds of fiscal stimulus. I mean, the most recent one from December, that was 900 billion. And people hardly talk about it. And that was bigger than the entire ARRA. So these are massive fiscal stimulus efforts, and we see it show up in the national accounts. So on some level, we just have to take into account that we know how it's working its way through the economy, and we can see what's going on. So from a macro aggregated perspective, we know that it's getting into people's pockets. We know that it's showing up in grocery store prices, et cetera. But which vehicle is saving jobs? I think it's too early to say. So.
Right, and I'm actually going to pick up on that last point that you just made, Jeff. Although, Mike, if you wanted to address anything in that last question, I'll want to give you an opportunity to do that here. Okay, great. So Jeff, you had talked about the several different economic aid packages that we've seen at the federal level. One thing I'm curious about, and one of the questioners was curious about, is with these substantial amounts of government expenditures. I mean, several $1 trillion over the course of a year. And during this pandemic, how much of a risk is inflation? What are the indicators that might be a sign of the reduction in purchasing power due to devaluation that perhaps we should be watching for?
It's a very good question. In public remarks, I don't say anything about in the area of monetary policy. So in some sense, this starts to drift a little close for comfort, but I will say, I did share with you all a slide showing consumer prices, and consumer prices are showing no evidence of overheating or inflation. When you look at wages, we see steady wage growth, but again, largely that's a composition measure. Folks who have held on to their jobs, they're disproportionately college educated and more well paid, as you showed and I showed, and their wage increases have just continued at a normal pace. They haven't picked up. There's been no spike in earnings, really unsurprisingly. But consumer prices remain subdued. Housing prices have certainly shot up, and that does matter for a certain segment. I mean, if you're a homeowner, right, you're now all of a sudden become more wealthy. If you're looking for a home, life has gotten harder for you, but that's inspired production. And so we've seen increase in production. So there's a number of factors that would point away from worry. And if you look to the public comments of the FOMC and folks engaged in monetary policy, they are essentially sending a signal to the public, that they are watching but not concerned.
Okay, fair enough. Great. And one that's a sort of an international policy question to a certain extent, if you would. The questioner asked about current spike in cases, in COVID-19 cases in Europe, and asked the question, will that significantly affect the New Hampshire and New England economy, given there's so many temporary workers from Europe who may not be able to fill some of the positions that we see in New England, particularly around summertime. I'll broaden a little bit to ask also about international impacts and lingering international impacts. Obviously, the pandemic is likely to become less of a risk at different rates in different places. So how might that affect the economy going forward? And I'll go to you, Jeff, first, if you would.
Sure. I think being watchful of international issues is I think a very smart thing to do. I mean, you're going to see it in terms of demands for travel and tourism. You're going to see it in terms of trade, exports, imports. Your questioner points out to foreign workers, which also is important for summer season for travel and hospitality travel. It's also our region is more heavily dependent on higher education than other parts of the country. Because of historic patterns. And so what we see is that foreign students have dropped off sharply. This actually preceded the COVID crisis to some extent because of other national policy decisions in terms of the immigration and the trade space as well. So those things do have an impact. Fewer in terms of how I think we should be watchful and worried. I'm going to hold off on quantifying like just how much we should be. I think, in terms of the business and the traffic that drive employment here in the region or in the Granite State is going to be more predominantly driven by domestic traffic, but certainly the international influence does matter.
Mike, did you have something you wanted to add as well?
Yeah, just a point that Jeff had brought up in his presentation as well. It's domestic or international. It's fairly dependent on how the pandemic progresses and the vaccine rollout progresses and the risks of public health lowering. So that's an important factor as well.
Mm-hmm. And Mike, I'd like to stay with you if I could and bring it back home to New Hampshire and look, as opposed to looking forward, look back a little bit. Could you speak a little bit more about wages and wage growth during the recovery from the Great Recession? I think this question was prompted by the graph that you showed showing the disparities in wages over time during the recovery from the Great Recession.
Sure. So that graph, we were looking at real wages, inflation adjusted wages, and we were comparing the overall change from a period before the Great Recession. So we used 2004 to 2006 to the latest data that we had before the pandemic, 2017 to 2019, and we averaged over those periods. So what the graph was saying is that earners who were earning higher than the median wage consistently over that period. So people, pre-Great Recession all the way up to end of economic recovery from the Great Recession. Those folks were the ones who saw the highest levels of inflation adjusted or their real wages. So they were the ones who benefited the most in terms of the economic recovery on their wages. Whereas individuals who were earning median wages or below, so just to put a number on that, the median wage in 2019 was about $20.50 in New Hampshire. So individuals who were earning lower than that, before the Great Recession, during the recovery, and up until 2019, those folks overall saw really no wage growth when adjusting for inflation, and they actually just returned to their pre-Great Recession levels. So those individuals, the ones who were most impacted by the COVID-19 crisis in terms of employment and income losses, took the longest time just to recover from the Great Recession. They had only recently returned to where they were before the recession, and then the crisis began, the current COVID-19 crisis. So I hope that answers the question that was asked.
Yes, I believe it does. Thank you.
Great.
And one other question to a particular segment that this is both in New Hampshire and New England, and I think, Jeff, I'll go to you first because I know you've looked at some of these numbers as recently as well, is housing production. The question was specifically about housing production in New Hampshire, but if you could speak to it both in the region and in the state, that would be of interest.
Yeah, there has been an uptick in housing production. It's been more pronounced nationally than in New England. Unfortunately, I would have liked to have seen more production. Massachusetts has actually seen an impressive uptick. So I haven't drilled down into the New Hampshire level, but we've seen increases in both permits and starts, and it would be nice to see if that continued. But as I think we all know, that the supply, the demand factor is only one part of the equation in terms of housing production in the region. We have a region that's full of very small units of government, and control is influenced. Where and how easy it is to build is partly affected by local limitations and regulations. So it's probably harder to build in New England for government, baseline government by regulation, but also we're an older and more developed part of the country. So the built environment is more already pre-utilized. It's easier to build in the in the sand states and in the Midwest and in the South.
Mike, did you want to chime in as well?
So this is actually data that I recently looked at. So this is a perfect question. Based off the most recent numbers from the Housing Finance Authority, or the New Hampshire Housing Finance Authority, Building permits for single family houses were up slightly, but not in a majority fashion. But multifamily or multi-unit permits were down. So that seems like a trend that has been consistent in general. But no, not that I know of, no major influx of new homes being constructed as a result of the increased demand.
Okay, great, thank you. And thank you for adding the New Hampshire specific data there, Mike. So I appreciate it. So there's another question which I'll go to Jeff first on this one as well, which is, given the disparity of impact, that it's much more dramatic for racial and ethnic minorities, for low wage workers, for those who are less highly educated, what policies can help mitigate some of these disparities going forward?
In terms of like during the crisis period, I think the policies, I mean, unemployment insurance is the exact right one to start with. That has the potential to respond quickly and to get money into the pockets of workers who have lost their jobs. And historically, the formula that this is a state federal program, and the states have a lot of control over the program, and including eligibility and generosity of the benefit. And the formula is usually set as, the weekly check is set pegged to some fraction of the pre-job loss earnings of that worker. So usually workers are left with, they're less well off than they were when they were working, which makes sense, keeps them afloat, but also gives them inspiration to get back and look for work. In this case, the federal policy actions ended up boosting that considerably. Many workers actually made more from their UI check than they were at their prior wage, which is actually helps sustain employment in other sectors and the rest of the economy fairly remarkably. So it's fast acting and fairly generous policy. It's since been knocked down, but it's been sustained in the new legislation. The federal top up has been restored. In fact, it was restored in prior administrative action as well, although not at the $600 level, at the $300 level. So that's, in fact, I think the exact right course of action to sustain those folks who have lost jobs. That policy vehicle will probably not be sustainable over a longer period. If you look back to the Great Recession, one of the things that people talked about for years was how long it took to replace all those lost jobs. So UI is not going to remain a viable vehicle for years and years into the future. So at that point, we need to start looking to other means in terms of potentially incentives to inspire employers to return to hire more workers. So demand side active and labor market policies. I think Congress could very well take up other sorts of transfers. You mentioned how in the ARP there's more funding for food assistance, the food stamp SNAP program. So these are other types of mechanisms. The financing of the classic UI program, being a tax paid by employers on current employment, is not going to be able to carry the weight too much longer into the future. I think that's actually now become a live policy issue for most of the states in the region. The trust funds have been depleted, and probably most states have borrowed from the federal government to sustain UI. So there will need to be a transition, and some of the things in the ARP probably are fruitful vehicles moving forward.
Mike, I'll turn to you as well.
Yeah, and just briefly, because I see we're coming close on the end of time. Policies that we had inequities before this pandemic began as well, and these are inequities that may have been exacerbated and have been exacerbated for certain groups. So especially groups with lower incomes. So programs that help support those groups directly, like additional SNAP benefits, unemployment to an extent for a shorter period of time, and other direct aid programs in the future are going to be vital to the short term recovering from the pandemic and the effects of the pandemic, and more medium term after those more severe effects are past.
Okay, great. And I see we are at 2:29, so we've had some excellent questions roll in, and I'm sorry we haven't been able to get to all of them. I'll note that relative to state policy, anyway, we did get there's a state policy question as well And I'll note that the next state budget period, as well as the aid that's coming from the federal government, comes at a pretty important time in the recovery from the COVID-19 crisis, but hopefully will be an ongoing recovery. The next state budget covers a 2-year period that begins on July 1st of this year. So that is obviously covering a lot of this key ground. And the American Rescue Plan Act is also has different timelines that extend to different amounts into the future to try and support that recovery as well. So there's both the federal policy and the state policy will probably play a really critical role going forward and continue to play a really critical role beyond the coming months and into the coming years of the recovery from this crisis. So with that, unfortunately there are other questions, but we're out of time. So I will thank the questioners and also thank Michael and Jeff, and we'll hand it back to Anne-Marie to close up the presentation.
Thank you. Thank you, Phil, for expertly moderating the Q&A, and thank you to Jeff and Michael as well for those exceptional presentations. And thanks to all of you in the audience for joining us today, taking the time to join us here today. We hope that this presentation helped you to better understand how the COVID-19 crisis has impacted the New Hampshire economy and the economic security in the Granite State. With the coming federal aid, New Hampshire has the opportunity to foster an economic recovery that is inclusive, equitable, and sustainable, and that reaches all Granite Staters. NHFPI will continue to provide new resources on the economy and the state budget process. All of these will be available on our website at nhfpi.org. We'll also be posting the slides from today's presentation as well as the recording of this event to our website, and we'll also be sending those out by email, so watch your inbox for those as well. So we hope you found this presentation to be helpful, and we look forward to your participation in future events. So thank you again for attending. Please be safe and well, and have a great day. Thank you.